The US government is currently terrified of a full-blown market implosion, highlighted recently by a severe 8% single-day drop in US chip stocks. While the Trump administration publicly claims the economy is booming with 73 all-time stock market highs since the election, they are deliberately ignoring a severe mathematical reality. This chart shows the true state of American economic performance. In the first quarter, the U.S. economy grew at an annualized rate of just 1.6%. Meanwhile, the national deficit ran at 5.9% of GDP. That leaves a massive 4% gap of missing efficiency. The government is essentially acting like a credit card junkie, wholly dependent on massive deficit spending to artificially simulate economic growth. This dependency carries a strict mathematical limit. Within 5 years, the sheer cost of paying interest on the existing national debt is projected to grow faster than the entire US economy. To survive this trap, the US government requires a constant, uninterrupted influx of foreign capital buying up its debt just to keep the lights on. If global investors recognize the underlying rot and stop buying US treasuries to fund that deficit, the American funding model breaks down immediately. The administration's economic architect, Scott Bison, has a singular strategy to prevent this collapse. He is attempting to engineer an artificially strong US dollar to pull fleeing global capital back into American assets. His primary lever to force this demand involves the historical foundation of dollar hegemony, the massive flow of Middle Eastern oil to Asia. This trade flow illustrates the exact threat Washington faces. Saudi Arabia is selling 4 times more oil to China than to the US and moving toward pricing those massive exports in yuan. That single move severs the dollar recycling mechanism, holding up US debt. Bison's countermeasure is aggressive. He is officially demanding that any potential sanctions relief for Iran comes with a strict condition. All of their oil exports must be invoiced in US dollars. The requirement that Iran invoice oil in the reserve currency aims to force the global recycling machine back into motion, providing the necessary funding for American deficit spending. But protecting the oil trade is only one front. Bison also has to defend the dollar from its most dangerous competing safe haven asset. This pie chart highlights a recent shock to Washington. Gold has officially overtaken US treasuries as the top reserve asset held by global central banks. Gold has climbed to 27% of total reserves, while treasuries have dropped to just 22%. A massive driver behind this shift is the People's Bank of China. They have aggressively accumulated gold for 19 consecutive months to systematically build a financial architecture completely independent of the dollar system. A rising gold price validates the narrative that the US is losing its safe haven status by successfully pushing gold below $4,000 an ounce. Washington sent a message. They will aggressively devalue any asset threatening the dollar centrality. The Treasury and the Federal Reserve are simultaneously deploying a loud public relations campaign, using aggressive rhetoric and the threat of sustained high interest rates to psychologically manipulate market behavior. By deliberately crashing gold and aggressively job-owning the markets, they try to maintain the perception that the US dollar is the only viable reserve currency left for global investors. The reason the administration is fighting so hard internationally traces back to a tragic domestic reality. The US government has to keep a deeply unequal K-shaped economy functioning to fake overall economic health. Looking at US consumer spending, the top 20% of earners account for a staggering 58% of purchasing activity. A stronger dollar inflates wealthy Americans' equity portfolios, creating a wealth effect that drives spending, falsely propping up national GDP to look healthy on paper. The brutal side effect of this financial engineering is that it relies on structural inflation and severe debt dependency, guaranteeing that the bottom 80% of the population will continue to lose real purchasing power. Those inflated GDP numbers are then paraded on the global stage as bait justifying continued foreign investment into US assets. These market movements in gold and bond yields are specific responses to the 300 basis point interest rate gap between the US and China. They are calculated attempts to bridge the capital divide by any financial means available. The ultimate question is whether global investors will continue to buy this strong dollar narrative, or if the unforgiving math of deficit spending is finally catching up to an economic model rotting from the inside out.